Hello, and welcome to another episode of the Financial Armor Show. My name is Brad Cooper, the president of Cooper Financial Investments, and I want to welcome my co-host today, Tony Shore. How you doing today, Tony?
Oh, you know me. If I was any better, my name would be Rick Black. That's how
Boy,
good I'm doing today.
that's pretty awesome for
Isn't that great?
for a Monday. Wow.
Yeah. I'm so good at hurts, as I like to say. No, I'm doing great, Brad, and it's great to be here. Thanks for having me on your show again, the Financial Armor Show. And again, you bring wisdom to the show each week, and we have a lot of great special guests.
Yes.
So I think before we go on, Brad, why don't you introduce us? A huge get for the show today.
You know, I have been so fortunate, so blessed the last few months as far as having some of the greatest guests on, some of the greatest experts in the United States today, which I thought was very appropriate, you know, as we're entering February to talk about taxes. And more importantly, you know, not just paying taxes, but, you know, how to minimize your tax bill and look at the future on maybe how to minimize, you know, taxes going from this point on. And we're going to talk about some of the changes in 2025 and really, hopefully at the end of this podcast, you'll know more about how to prepare for your taxes. And lastly, who to really look for when you're looking at a tax professional, a CPA, accountant. There's various names. What should you be looking for? And I'm real excited to have one of my dearest friends, Tony. I've known for, wow, I'm dating my age now, over 35 years, maybe longer than that.
You must have met when you were both 7 years old? Or
oh, actually, I think toddlers.
Years old, so I don't know how that's possible.
You met when you were pretty young.
Yeah, still in the womb we met. And but no, Rick Black has been a accountant, CPA for many, many years, over 3 decades, going on, I believe, 35 years now. And what we often talk about, because we always incorporate, you know, a CPA, most of the time it's Rick, into our practice, involved with our meetings. And I always talk about the majority of his industry is what I call order takers. What's an order taker? You take your W-2s, your 1099s into the tax preparer, and they input all the stuff in the computer, and they tell you how much of a refund you're going to get or lack of. A tax planner is really the busiest time of the year, and I'm probably stealing some of your thunder, Rick, is usually the last quarter of this year is planning, meeting with the client throughout the year and helping them how to minimize their overall tax bill. So, Rick, welcome to the show today. Thanks for your time
Thank you for having me
here. So, let's go ahead and get started, Rick. You know, right now you're entering a busy time, tax season. Your wife, your children, your grandchildren will not see you for the next 3 months, which that's okay. They are excited about that. I did talk to them, and
yes.
But what are some of the things that you're seeing, you know, as we enter 2025 that could impact, you know, your clients, our clients, when it comes to taxes? And what's some of the biggest areas that people are not seeing when they're doing their taxes, that if you could just say, wow, if you could just pay attention to this, this, and this, that would help?
The biggest issue, especially younger couples and that, hey, I want a $6,000, $7,000, $8,000 refund. Now, I know I've discussed this several times. Why do you want $6,000, $7,000, $8,000 refunds? I just had a young couple Saturday. I worked on their tax return, and they were just gun-ho happy that they were getting that kind of a refund. And I said, I tell you what, why don't you just go ahead this next year, write me a check for $6,000. I'll hold it in my bank account, and I'll pay it back to you next year, and I'll draw interest on it and just give you your six back. The objective is not to get big refunds, is to minimize your refund, because you don't want that. You want to invest it. So guess what? We're setting them up, doing something with their money, maybe a Roth, traditional IRA, and they're going to earn hopefully 10, 15, 20% on their money. But that's the biggest thing we look at. We just don't look at what the amount of the refund is. How can we help you minimize those refunds and invest them, make better money with better options for your money?
So
that's
right, you don't want to owe money at the end of the year. Nobody wants that. But if you get too big of a refund, the government's been making the interest off
That's
that,
absolutely
which
right. How
you
much
could
do
have
you
had
make
that
on it?
invested, and all that compounding interest that Brad, you're always talking about, right?
Absolutely. Do not give the IRS a 0% loan.
Absolutely.
Basically, use that money. And I know we've had mutual clients in the past years, Rick, where we have made some adjustments with your help to take out less of their monthly paycheck. And some of these families
Invest it.
are, yes, making an extra $500 to $1,000 per month, in their paycheck. Then they have control of the money. They're earning interest and gains on their money.
And the IRS came out with something, findings. The average refund for the taxpayer in this country is $6,000.
Wow.
That is $500 per month. You could be doing something with it. But that's the average refund in this country. So you take that, that's a $6,000 interest-free loan you've given. And that's why I always joke with my clients. They look at me like I got a third eye. I say, well, just give me $6,000. I'll put it in a nice, safe bank account. I'll give it to you next year with no interest, but I'll keep the interest.
Sure.
And, they look at me like, what? And I said, well, that's what you've done to our government. So, that's some of the different things. I'm just not a tax preparer. I like to help minimize tax burden, but also don't give away free money. And that's what you're doing by doing that.
Yeah.
Since you mentioned the number 6,000, which that's a little bit higher than I thought. We're just looking at the new 2025 contribution limits if you're under the age of 50, and whether it's a Roth IRA or a traditional IRA, it's 7,000. So you're right, Rick. You could almost break even and use that money to fully fund a Roth IRA. So tell our listeners, especially maybe younger ones that are maybe not familiar with the advantages of Roth IRAs.
A Roth IRA is after tax dollars. What does that mean? You've already paid taxes on that money. So you take that. I always, my joke is it's clean money. It's all yours. Nobody else gets that. It's yours. IRS can't touch it. Clean money. You can invest it. And as long as you meet the qualifications and keep it there, like, 5 years? Right. And in 59 and a half, you could draw it out. And guess what? Every penny you've made is 100% tax free.
Principal and the interest you make, right?
That's correct. Your 5,000 plus whatever you make. If it's up to 50,000 when you're done, you get all 50 tax free.
Well, I love what you guys are saying, because that tax free Roth that you're talking about, the Roth IRA, is so beneficial later in life. Plus, you let it roll up with that compounding interest. And Brad, what you were pointing out is, hey, Rick said you're overpaying on your taxes. If you get a return, it means you've paid in too much to the government.
Correct.
So instead of paying too much, keep that money back for yourself, reduce what you're paying in each month for taxes, take that money and contribute it to your Roth 401k or IRA, and then you'll have that, instead of a $6,000 or a $4,000 return, put that money into a Roth. Is that what you're saying?
Correct. Absolutely. And then you're making money. The market has done great. I mean, 10, 15, 20% you're making on that money. You do that for 25, 30 years. Guess what? You got a nice little retirement.
Yeah.
And it's tax-free. And speaking of taxes, which this is what I love about the impact that Rick and other tax experts like Ed Slott, who we had on the show a couple months ago, and their team is helping us with our clients. Right now, if you look at federal income taxes, Rick, I think we're at almost 100-year low.
Yes.
And the chances of them staying low and getting extended for another 4 years as of now is looking pretty good. So what we're doing with the help of Rick and his team with our clients is showing clients in a strategic way on how to start shifting money that's in maybe IRAs, 401ks, pre-taxed accounts, and moving that money over to tax-free accounts. Most common is Roth IRAs. And you got to be very careful when you're doing that, right, Rick? What would happen if someone just said, you know what, I don't need Brad Cooper, I don't need Rick Black, I don't need Tony Shore. advice, I'll do it on my own. What's the consequences?
Taxes, and also Medicare. You got to be careful of that, because if you convert too much, you could be hit there if you're over 65, paying additional Medicare taxes if you're not careful. So you've got to make sure and talk to a professional and see how much can I convert without getting in and paying additional taxes. I mean, there's huge gaps in these tax brackets that you jump up to. So what you might not think is a big deal, you might be paying an extra 8% on taxes.
And most people aren't aware of that. I just had a person a couple years ago. We were just talking outside the office, like maybe at a ball game. And this is the type of person, Rick, which I know you have talked to in the past, that just wants to pick your mind and learn from you, but not take your advice. Well, here's what happened. Long story short, we were talking about tax planning, talking about what services that you help our clients with, Rick. Well, instead of asking for my help or your help, this person went out, converted in 1 year $160,000, which, for some people, that's okay. In their case, they were getting insurance through the marketplace and being subsidized. Plus, their children, this is a younger couple, they had children getting a special assistance from the state. So when they did their taxes, they had to come up with about $40,000 in taxes, and they lost all the benefits.
Mm-hmm. Yep. Brad, what's the number one word I say before I talk to any client? Brad, you should know this word.
Oh, I do.
Depends.
It depends.
Depends. You might, Brad, get a deduction. I might not be able to. It depends. You got to know the whole circumstances and truth, what's going on.
So their kids lost certain benefits that they were getting, right? Because it put them in a higher income bracket, because that showed up as income. Correct. So they no longer qualified for government subsidies for their health care and for their children. And that's just a huge, costly mistake. And you've seen people make these mistakes all the time, right, Rick? Right, Brad? Oh, yes. And they come to you after the fact saying, what can I do?
Nothing you can do after the fact. I mean, that is the thing. That's why it's more costly on the back end than on the front end. Get the right advice, get the correct help, and do it correctly. I see it all the time, even with business owners. We do tons of business owners. They want to try to do the shortcut. I don't need to. I'll try to do brain surgery on your own, see what happens. Mm-hmm. I mean, get the correct people and do it. I mean, and do it correctly. You'll save in the long run.
And what we do see not as often as we used to is, people that just want to save, a few $100 and do it on their own. And that's where a lot of the mistakes come from. But, one topic, Rick, I want to bring up, which we have in shows past, especially because of the timing, RMDs and QCDs, Qualified Charitable Distributions. If you're 73, that's the age right now, this year or older, you have to start taking required minimum distributions. And that's a percentage of your overall total IRA money. So we're trying to avoid that. And we're doing a great job with the help of you and your office, Rick, with, minimizing what total IRA money they have when they turn 73, especially if they're younger and we're doing tax planning. But let's talk about just for a minute and the importance of qualified charitable distributions. Kind of explain to everyone, and you can do that at 70 and a half. Qualified charitable distributions.
So it works twofold. One, that is, you take that money out of your IRA, and the good part of it is does not show up on the front page of your tax return. It is tax-free. It does not show up as part of your AGI. However, the nice part is you get to use it on the back end. Nowadays, a lot of people aren't getting to itemize. Why? Because back in 2018, the government doubled everything. So only about 10% of the population are getting itemized now. I mean, you got to have a ton of medical, you got to have a ton of charity. It's about about the only way that you can qualify for itemized. So here's your benefit. You get to lower this, and maybe something on the back end, like Medicare, make sure your premiums stay down. It keeps your AGI down and helps you on if you're in the marketplace insurance.
Your adjusted gross income,
Correct.
and you want to keep
yes,
that,
adjusted
and
gross.
you want to keep that down, right?
Yes,
Because that's your income that shows up on your tax form. That
Right.
puts you in different brackets. That's going to bump up your Medicare
that
payments,
is
right?
the most important thing on that tax
Sure.
return is that AGI that drives everything. Another gold one for married couples is 150K. That's where you start losing a lot of benefits. So we try to keep them under that 150. I mean, it could be college for your kids. It could be marketplace insurance. That is the golden number, is at 150. Especially if you have rental property, you don't get those deductions if you're not a real estate professional. So we drive that 150, my staff and everything, to make sure people stay under that 150 so they can get all their deductions.
Sure.
So,
Last week I had a meeting, Rick, with a gentleman, and the timing of this topic is so important because let's say you want to give to a charity, a nonprofit, a church, and of course, like you said, really you're able to send money directly from your IRA to the charity tax-free, in essence.
correct.
So, but be aware, because if you're over 73 and you're required to take RMDs, required minimum distributions, the first money that comes out of your IRA in a calendar year is applied toward your RMD. So if you're planning on giving in 2025, just to simplify this, let's say that your RMD amount is 10,000 and you want to give 5,000 to a charity. You want to do the qualified charitable distribution first. Then that will lower your RMD amount in this example from 10 to 5. However, if you take your RMD 10,000 first, you're going to pay taxes on that. Then you still can do a qualified charitable distribution. You will get tax benefits, but not as great as if you were to give your charitable contribution first. And that's something that a lot of folks are not aware of.
Yeah, and right there is just a little bit of tax savings. I mean, that is not a huge amount, but at least why give away free money?
Right. And another acronym there, or RMD, right? Another abbreviation, which you said stands for required minimum distribution. I always thought, when I hear it, I think really massive donut. I always thought that's what RMD stood for, is really massive donut. But regarding the charitable distributions, I think people, just to clarify for our listeners and viewers out there, you're talking about, people think, well, in order to get that tax break, I got to give my money away somewhere. But a lot of people are doing that anyway and writing checks out of their account. And my parents are one of them. My dad is 80 and my mom is in her late 70s. And for every year, they cut a check, or twice a year, to the church.
Mm-hmm.
And they they write it out of their checking account. And I told them, I said, and this is after I started doing a show with Brad and learned this. I said, you guys have the IRA here. You could be, you're paying taxes on money you don't have to be, and you're making your AGI go up, your adjusted gross income, when it doesn't have to be, and you can get better benefits. All you have to do is have that, because most churches qualify as for a charitable contribution, and a lot of people have charities, even if it's not tithing to a church, it's something else that they support, Children's Hospital or something. And so, Shriners Children's Hospitals, a cancer fund. So you need to look at that, but don't try to figure this out on your own, right? I mean, Brad and Rick, that's the key. I mean, Rick, you've been doing this for taxes for, I assume, 150 years.
And this is a big thing that has come up, and a lot of people are doing now, because most odds your parents didn't even get to deduct that because they probably didn't qualify enough for itemized deductions.
No, at that point, they did not. They used to.
Yes. And that's why since 2018, we're seeing more of that. And that's why I'm doing more tax planning with my clients and Brad's clients. Hey, you're going to get to the church anyway. Let's get at least a tax benefit. and by doing your RMDs.
And everybody wins. The church gets money
Yes.
tax-free. You're giving it tax-free. It's a win-win-win.
Absolutely.
The only one you're kind of leaving out there is Uncle Sam, and he's going to get enough of your money anyway.
Yes.
Right.
The biggest thing I would say on that is make sure to tell your tax professional you are doing that RMD, because it does not state that on this report that comes from the 1099-R from your financial advisor. So you need to make sure we have it in big, bold letters on our questionnaire. Did you make a QCD this year? Qualified Charity Distribution. And that way you get that benefit, because it will not state on your 1099-R. So definitely, it's a must. You got to tell your tax professional that's what you did. And you've also got to tell Brad's people, hey, this is for a QCD. So, because it's easy to fall through the cracks if you don't tell your people. They don't know. So make sure you do that. And like I said, it's more prevalent even in the CPA world. At our seminars, a lot of people are doing this because of the lack of getting itemized deductions. So this is a must that we need to put in. That's what we tell our people during our tax plan. Get this done.
I'm glad you brought that up, Rick, because you're right. Whether it's Charles Schwab, Fidelity, any of the custodians, they do not mark on the 1099, that it is a qualified charitable distribution. So it falls back on the responsibility of the investor, your client, my client. And so that's something that we're sharing. I just want to share, a quick story that happened about a year ago. I've shared this before, I think, Tony, on the show. But speaking of QCDs, Qualified Charitable Distributions, met with a wonderful couple about a year and a half ago, 78 years old, husband and wife. For the last 8 years, they have been giving close to $100,000 to their church. I mean, wow, very, very blessed. They had a lot of, IRA money and a lot of other funds. But the question,
they must have been CPAs.
Yes.
No, that's why I'm working.
I think they were retired CPAs, come to think about it, Tony. But, if you could have just seen the look on their face when I asked them the next two questions. Number one, how did you pay that? And I got a weird look. And the wife, pulled out her, purse, pulled out her checkbook. I wrote a check, Brad. How else? And the look on my face, they noticed. They knew something went wrong. So long story short, over the last 8 years, they have given over $800,000 out of their checking account, not out of their IRA. They lost out, Rick, what, $250,000 in tax?
$250,000 in taxes, state and federal.
Crazy.
They lost out on.
So
was that worth a tax return by a professional CPA? I don't think I charge that much, or I wouldn't be here.
Right.
Maybe you should.
Yeah.
But that is some of the faults, and that's even in my profession. I don't know. That's why we take it a step closer. We work with our clients and say, how can we save tax dollars? I am not a tax preparer. I sit down with my clients. I work with Brad's clients very closely, and we try to find tax advantages. Just that little thing. I mean, one little mistake, $250,000 it costs that family.
You said something there, Rick, that is the most important thing I think that I've heard from either one of you on today's show, and that is, you can do the taxes yourself online if you're single and it's simple. You can take it to one of these little places that pop up inside another store or a strip mall, but that's a tax preparer. That's not tax planning. There's a huge difference, isn't there? Tax planning is where you get to know your clients. You work with them year in and year out. You get to know them and what they're doing and work alongside Brad, who's got an overall financial picture. And you guys are looking at the big picture. You're not just looking back at last year's W-2 or whatever it is, or 1099. You're looking at the big picture.
Absolutely.
And that's where you're going to avoid the costly mistakes, whether what level you're at. I mean, some people are out there saying, well, I'm not at a level where I could make a $250,000 mistake. But if you're not at that level, you might make a $10,000 mistake, which could be just as impactful for where you're at. Right.
And that's what we do to our clients here. We don't charge our clients that way. I mean, I want them to feel that freedom to call Rick anytime and, hey, Rick, how does this affect me? And I want to give them that answer because I don't want a surprise on April 15th whenever I say, hey, you owe $250,000 in taxes. Shame on you for not asking.
Yeah.
I don't want to tie their hands because one little thing, I don't want to bother him. It could be very detrimental.
Sure.
So we try to work closely. I want clients happy. My best thing is making happy clients.
Yeah.
And, and be honest with your tax professional and your financial advisor because as I tell people, we're doctors in a different sense. We're financial doctors. We know more about you than your medical doctor does. I mean, I know everything about my clients because I get to know them, and we try to do their best possible ways to save them tax dollars. I'd rather go to the family than to the government that manages our money so well. So we want to manage it yourself. We want it to get put in your pocket.
One last thing I want to add to what you said, Rick, which is not the norm, Tony, neither in the CPA world, the financial planning world, or the attorney world, is Rick and his team of experts do not charge by the hour, do not charge by the minute. You know how many times, this just happened about 2 weeks ago, I asked one of my prospects that I met for the first time a question, and I said, well, why don't you consult your CPA? And they said, well, I don't really want to do that because every time I call, I get a bill for $200. So work with a planner that is, fee-based like Rick, that you can call, you can email his team and save the mistake, like you said, Rick.
I'll answer any question for $200, by the way, if any of our listeners want to call me. I'm free. I'll throw out my number right now if they want to call me. Now, I can't guarantee the answer will be correct, but that's for that. You need Rick and and Brad. So, well, we're out of time, guys. It flew by, but Rick, I think Brad's going to have you back on the show to continue this discussion. Maybe after tax season, though, right, Rick?
Sounds good to
me. After he gains consciousness, from surviving tax season. But, we went through a lot of great information. Rick, again, thank you for your time. If you have questions for Rick, you can visit our website, financialarmorshow.com. Again, that's financialarmorshow.com. Ask any question you want. We'll pass those on to Rick. You will get an answer, or just call directly, 888-390-5277, and ask any question you may have. And you definitely want to be working with a CPA planner who understands the updated tax laws. One area we didn't get into in detail, which we will in the next call, is the impact of the Secure Act and how that is impacting so many taxpayers. And if you're not working with a planner, you're not getting that advice. I can tell you that for sure. So thank you, Rick, again for your time.
Thank you all for having me.
All right. Well, guys, great show. And listeners and viewers, thanks for tuning in. That does it for today's episode of the Financial Armor Show with our host, Brad Cooper, and our special guest today, CPA Rick Black.
Thank you, Tony.